Hi, everyone. So as Alistair shared, I moved to Montreal from San Diego in December. So it was kind of the beginning of winter, and it was my first real winter that I lived through as an adult. And so I just kind of have this special place in my heart for Alistair and the suffering that he put me through, which led me down this path that I'm on now, which I'm really happy about. And so speaking of suffering, I'm going to be talking about raising your Series A, and specifically whether your product is ready for a Series A. And a question I just want to start with, you don't have to answer this in the chat or anything, but just kind of think about this question. What do you think investors look for when they're evaluating your startup for a Series A? Just think about it for a moment. Okay, so in my experience, there's essentially 6 things that investors focus on at the Series A. Whether you have product market fit, how much revenue you're making, your growth rate, how amazing your founders are, how big your market is, and then just why is this the right time to build this kind of company? And if you look at this list, there's kind of 2 interesting things that stand out. One is that there's only 3 things that you can actually impact between the seed round and the Series A. Your signals of product market fit, how much revenue you're making, your growth rate. And then the other is there's a reason that the Series A is called the product market fit round, because this is the stage where you start to move from searching for something that people are trying to build to raising money, pouring fuel on the fire, and then scaling from there. So what I'm going to talk about in our talk today is I'm going to help you learn 3 things that I think would most help you have a successful Series A, focusing around the things you can actually have an impact around, which are knowing if you have product market fit and how to communicate whether you do or not, diving into an element of product market fit around retention and helping you understand what is good retention and what is great retention, and then helping you understand how to develop a growth strategy and how to think about growth in general. So this is going to be our talk today, just these 3 things. And I'm not going to be sharing just my personal opinion and my experience. I'm going to be sharing my learnings from researching basically every successful company I can get my hands on. As Alistair mentioned, a lot of these I reached out to the founders and got their stories, talked to early growth people or early employees at these companies to understand what they learned about what worked for their company early on. And so everything I'm going to share is going to be based on my research into all these different companies. And then just a little bit about me. I think Alistair shared a lot of this. I was an engineer for about 10 years before I started my company in Montreal. Had that for about 1.5 years. We sold the company to Airbnb. I stayed there for about 7 years, where I led the supply growth team for a few years, led the conversion team for a few years, helped launch the Superhost program, revamped the review system, and a bunch of other cool stuff. And I left that about 2 years ago now. And now I spend my time on this newsletter that we talked about, very creatively called Lenny's newsletter. And in that, with the newsletter, I actually have a chance to research how companies grow and what works and what doesn't, and share that with my readers. And so here's some examples of the articles that I wrote, and this is essentially what this talk is based on, is some of this work. And in addition to the newsletter, I also do a bunch of angel investing. I've actually invested in about 70 companies at this point over the past 5 years. And here's a few of them. And what's cool is this gives me a really unique perspective in addition to the newsletter of how companies start, how they scale, how they grow, and then the challenges they have. So everything we're going to talk about is based on all these things. And so let us start with part 1. And what we're going to talk about is just how do you know if you have product market fit? It's this very vague idea, and I've kind of found that it can be a lot less vague. Very simply, product market fit is just a question of whether there is a market for the product that you're building. That's as simple as it gets. And as Mark Andreessen famously said, and you can't have a talk about product market fit without using this quote, that the only thing that matters for a startup is getting to product market fit, because that's all the value you have for the world, is that you're building something people actually want and need. And so, and again, at Series A is where you want to show that you've gotten to this place. And what I found in my research is there's essentially 3 signs that you have product market fit based on all the interviews that I've done with all these successful founders. And I'm going to go through all these in detail, but just briefly, you look for a sudden and significant pull from the market, or gradual but compounding pull from the market, or or actually, your cohort retention curves flatten, and I'll explain all these things. Okay, so the first sign that you have product market fit, and this actually ends up being the most common story that I hear from founders of successful companies, is that you're just feeling the sudden and significant pull as soon as you launch something. So a few examples. Drew Houston shared that when they launched Dropbox on Dig and Hacker News, actually, there's just kind of this visceral sense that things just started to take off and had this kind of life of their own. And he was kind of in the back of, he got pulled into the back of his seat and this car was just racing away. So that's kind of the feeling that founders describe. Netflix had a similar experience where once they iterated towards what is now Netflix, they got to a place where all of a sudden they just like couldn't keep up with what people were asking for and the amount of demand they were feeling. Uber, similar experience. Once they got to a place where they had a product that was working, they had the sense that just word of mouth was just uncontrollable. And then, yeah, there we go. Segment, same thing, that they had this feeling before they launched. It was their third iteration actually of Segment. Before they launched that, it was kind of this, they just had to like push their ideas on people. And when they launched what is now Segment, I think it was called analytics.js, they had this immediate pull, and it was very clear to them things were just being pulled from them now. And GitHub, same thing. They had sort of similar, actually. They weren't actually charging for anything initially, and they were just kind of feeling, or people started reaching out to them like, I want to pay you for this thing because I don't want it to go away and I really want this thing. So these are ways to notice this feeling that people are really, really, really badly wanting what you're building. So that's the first bucket. And this is hard to miss. This is the kind of thing that a lot of founders just say it's hard to miss. You know it when you see it. And this is what it feels like. The second bucket, which is easier to miss and also comes up often, is this gradual and compounding pull from the market. And again, it's not as obvious, but once you see it, then it becomes clear and clear over time. So a few examples. Substack, I love the story where the founder of Substack was obsessed with understanding if you have product market fit and was looking for it and looking at all those metrics all day, and eventually got to a place where he just didn't have any time to worry about it because things were moving so fast and growing so fast. And so that's one way of feeling this type of product market fit. Instacart is a really good example of what I talked about earlier. Just all product market fit means is that there's a market for your product. And what Instacart found is they found a very small market for their initial product, which is people that just don't care what store your food comes from. And they found value in Instacart. And then they continue to expand the product and grow the market. So they found a very thin slice of product market fit and expanded from there. Superhuman is a similar story where they, if you know about their whole product market fit search, they kind of found that there was a sliver of the market that really wanted Superhuman, and they continue to improve the product and continue to grow how badly people wanted this thing. And as Rahul shared, that they found these pockets around founders and managers and executives and continue to expand on what value they found, and then additional personas from that. And then Datadog, a very good example of this idea of gradual but compounding pull. They launched and there wasn't this explosion, but things just continue to grow and continue to, people continue to sign up, and it never stopped. And for them, it was just like, all right, this is working. So something you may be thinking about as I'm going through this is just how long do these periods take? How long does it take for like a Netflix or an Uber to get to this feeling of product market fit? So let me answer that. Here's what I found from talking to these founders. It's actually a long time. Like the shortest amount of time of all these companies that I noted was about 1.5 years. The Netflix started with other things, and then they kept tweaking and iterating and got to a place where, oh my God, I really want this thing. Segment, same thing. Talked about how it took them 3 tries to get to something people really wanted. Amplitude took 4 years of iterating and understanding the market better and better and better. So these things take time, even though it feels like it's sudden and significant and it comes out of nowhere. In a lot of cases, it takes a while to get to that sudden and significant point. So something to keep in mind. Okay. Third way of knowing if you have product market fit, and my favorite, and this is the most practical and quantitative, is to look for your cohort retention curves to flatten, which I will explain. First of all, what is retention? Retention is just a measure of the number of people who continue to use your product, who start using your product and stick with your product. And to me, retention is the ultimate measure of whether you're building something people want, because by definition, people continue to use your product, and that means they find value in it. And so this is a really good place to start when you're trying to figure out if people want what you're building and if you have product market fit. And there's actually two ways roughly of measuring retention. There's monthly retention, or weekly or daily, but usually it's monthly. And what you look at there is just every month, what percentage of my active users or customers leave that month. So it's like every month we lose 5% of customers. So that's one way of approaching looking at your retention data. The other is looking at it by cohort, which just means looking at a slice of users who joined around the same time and watching their experience over time. So instead of everyone in this month, how are they doing? It's people that joined, say, March 1st. Where are they a few weeks later, a few months later? And that's called a cohort, and you look at their retention over time. And so you could look at something like, 30% of users are still active after 3 months. And in my opinion, the second bucket is the way you want to be thinking about retention and tracking retention, because the other approach blends together new users and existing users. And you can tell if changes to your product are having an impact because you don't know what percentage of those are new to the product and were impacted by that, say, new onboarding experience, new landing page, versus when you look at it by cohort, and here's actually a zoomed in view, you could see how people that joined in a period, what's changed? Do they have better retention? Do they have worse retention? And what did we change that made that change? And just to think about this a little bit further, the way this works basically, and this is one way of looking at retention, is if you look at, say, May 5th. So there's about 68, I think, users that joined in that week. And you could track of those 168, how many are still around at 10 weeks, which is 14%, and then eventually only 6%. So that means you're losing 94% of your users eventually. So not great. So this is one view of how to think about it. The other is by looking at it as line charts / curves. And this gets to this third measure of understanding if product market fit. What you do here is you map each of your cohorts, say all the people that joined in a week or a month, and you plot them on a line chart like this by week or by month or by day, and you see where it starts to flatten out. And where that flattens out is essentially what percentage of your market that you're selling your product to finds value in your product because they stick around. So here you could see that initially cohorts seem to be stacking on each other, which means retention is improving initially, but then eventually they all flatten out to 10% about. So that's interesting. And the way that you look at this is basically, if that curve flattens out and doesn't drop to zero, you have product market fit with some segment of the market. If it doesn't flatten out and goes to zero eventually, you don't have product market fit. No one wants what you're building. They all leave eventually, even though you may be growing fast. So this is the way you use this third bucket and metric. And you're probably wondering, what percentage is good? Where should I flatten? What percentage tells me a product market fit? And I'm going to tell you. But first, let me share 3 other early signals of product market fit that you can use if you haven't gotten to one of these 3 yet. The first is the classic Sean Ellis survey around asking your users what percentage would be very disappointed if your product left. And in his experience, if over 40% of people say that they would be very disappointed if your product disappeared, you have product market fit. In my experience, it's not necessarily true, but it's a good signal, and it's a nice stat that you can use in your decks when you're talking to investors where, look, we're looking good here, even though we haven't hit one of these other 3 milestones yet. 2 is something Steve Blank talks about that I love, and this is especially useful for companies that haven't launched anything yet or are still at the idea stage or just a prototype stage. Is he looks for people's pupils to dilate and get really visibly excited about the thing that you're talking to them about or that they're using, because that tells you that they're not just telling you that they're going to use your product, but they're just like, oh my God, I really, really want this thing. So that's a sign. And so I don't know, you can probably reference that in your decks, number of pupils dilating. But more realistically, this is just a sign that gives you confidence you're building something that people are going to use. And then the third, and this comes up a lot with investors, is that people use your product even if it's broken, even if it's down. They're really sad when it's down, even when it's not doing exactly what they want. That's a sign that you're building something people really want. And there's a few products actually right now for my newsletter I use that are just like not amazing, but there's nothing better, and I continue to use them and I pay for them. And so that's a sign that you're building something people really want. So there's three really consistently high quality signs that you have product market fit, and then there's these three early signals. Okay, so let's talk about retention. And so retention is is a kind of an element of product market fit, but it's a very special element because, again, by definition, it tells you if you're building something people want. Okay, so the question is, what is good? What is good retention and what is great retention? What I find is people always talk about product market fit and they're just like, I don't know, like here's the number I've heard from an investor once. Here's a number that a growth expert I know told me that's good. And then that's like the number they roll with. And so what I decided to do is I decided to triangulate across all of the smartest people that I could talk to in growth and product and investing, and kind of triangulate on what they all kind of consensus-wise land on what is good retention for a product. And so what I did is I surveyed all these people plus a bunch more and triangulated a place that I find that ended up being pretty consistent and useful. So the question I asked all these people was, what do you consider good retention? What do you consider great retention at 6 months? And one takeaway from it initially was that it's very different based on the type of product you're building. And I'll explain why. But let me just quickly go through the actual numbers for each of these types of companies, and then I'll talk about why they're different. And then I'll actually give you a link where you could go look at this in depth. So you don't have to take any notes or anything. Okay, so for a consumer social product like Twitter, Snapchat, Instagram, products that are supported by advertising, good retention is at 25%. So this means at 6 months, 25% of your new users should still be around. Great retention is 45%. For a transactional consumer business like Airbnb, where you just buy it once and move on, or Lyft or TurboTax, you want to have about 30% of people coming back in 6 months and still using the product. And if you're above 50%, you're in great shape. If you're building a subscription business, a consumer subscription business like Netflix, Spotify, Hulu, you want to be at about 40%, and you want to ideally be over 70%. If you're building a mid-market subscription business that's basically selling to companies that are like 100 to 1,000 employees, you want to be at about 60%, ideally at 6 months, but even better, you're in great shape if you're above 80%. And then for enterprise software, good is 70%, great is 90%. Here's a little snapshot if you want to take a screenshot of all of the good and great benchmarks. And to give you a little bit of why they're so different, one is that the cost to acquire users scale basically linearly through this list. So at the consumer social spectrum, it's very cheap to acquire a Snapchat user and an Instagram user, very expensive to acquire an enterprise. And so in order to make the business work, you need to keep a lot of those customers that you're spending all this money on acquiring. And so basically the business just won't work unit economics wise if you're not retaining that many users at these larger companies, basically. So that's one. Two is that the types of customers are very different. Small companies go out of business a lot more often. Small companies change products a lot more often versus an enterprise where they sign a big contract for a year, they train everybody, and then it's hard for them to switch. And so if people are churning from your product as an enterprise business, then something's going wrong. And people like really don't want what you're building because it took all this work to convince people to buy it and sell it and acquire it. So this link at the bottom, by the way, is a link to the post if you want to get a lot more detail on this. Oh yeah, so this is important. So a lot of founders see these lists and they're like, oh my God, I am not doing well. And so I just want to share 3 reasons why it's okay for your retention to actually be lower than these benchmarks. One is you're just starting out and you haven't really built the thing yet, and you still have a lot of things that you need to fix and improve. That's okay. Retention's not going to be at the peak immediately, but I wouldn't let that be an excuse for long, because in my experience working with a lot of startups, it's really rare the retention goes up significantly from your base retention. Usually it goes a little bit further, but it's often as soon as you have something that's like the core insight of your product out, that's often where retention ends up being. So you can't use that excuse for long. 2 is there's some products like Twitter is an example, and Shopify is actually an example where their acquisition costs are actually pretty low, and the marginal cost of a new user is also basically zero. And so in their cases, churn isn't actually a huge problem. They don't spend a lot to acquire people. And so it's okay for their retention to be a lot lower. Like Twitter's retention is really bad, and they're doing all right. And then the third is you're just like not building a venture scale business, and you don't really need to scale as fast as a VC-backed business needs to scale. But we're talking about raising a Series A. You probably are not in that boat. So you can't use that excuse, unfortunately. Okay, so third, we're going to talk about growth strategy. And what I'm going to do is I'm going to share a couple of frameworks that I found to be really useful for thinking about your growth strategy overall, and then just like how to actually grow your business. And I'm going to talk about 2 things. I'm going to talk about how businesses grow long term. Like how will your business grow long term? What are the options? And then how to get your first 1,000 users, and how companies get their first 1,000 users. And this is for folks that are just starting out. Okay, so long term, what I find is that it's really valuable to think of your startup like a race car with these 4 key components: the engine, turbo boosts, lubricants, and fuel. And I'll explain all these things. The engine is the most important part. The engine, coming back to your actual startup, is the self-sustaining growth loop that drives the majority of your business's growth. And basically what I've found working with other colleagues is that there's only 4 ways that your company is actually going to grow long-term. There's only one of these 4 engines is going to be responsible for the majority of your growth. So it's really important that you figure out which of these engines is most likely to drive your growth, and then become really, really good at that engine. And I'll explain how they work. But as a few examples, just like Airbnb, the way Airbnb grew, basically it was all virality initially once it got going, and then it became performance marketing driven partly. Thumbtack grew mostly through SEO, and then they layered on performance marketing. Booking.com started with SEO, and then they actually shifted almost completely to performance marketing. So it's really simple. If you look at every company, one of these 4 engines explains almost all their growth. And the way they work, just to give you a sense of why they're called engines, it's because they sustain themselves through some kind of fuel, which we'll talk about. So the way performance marketing engine works, spend money to run an ad, the ad drives the customer generates revenue, which lets you run more ads. And these companies on the far right are examples of companies that grew primarily through performance marketing. The second engine is a content engine. SEO is a really popular version of this engine. And the way this can work is you get users generate content, say reviews or comments or answers to questions. Visitors come to those pages through SEO, and then they generate more content, and it keeps going. And the companies up to the right here are really good examples of companies that grew through this engine. The third engine is the sales engine, which is something that I think is very straightforward to understand. You hire salespeople, they bring customers generate revenue can hire more salespeople. And this is generally how B2B businesses work, especially non-bottom up businesses like the ones to the right here. And then the fourth engine is virality, which there's a number of ways virality works, but the most typical is users sign up, invite their friends sign up, invite their friends, and it keeps going and going. And what's interesting about virality is it works often for consumer social networking messaging products, but also for bottom-up SaaS businesses. That's what's beautiful about bottom-up B2B businesses is they combine the magic of a viral, cheap growth engine with the contract size of an enterprise business. And that's why they're so popular among investors these days. So those are the four engines. And the question is, which one's right for you? Here's a little bit of a heuristic that'll help you think this through. I'll just go through this briefly. So performance marketing is likely the best fit for your company if you generate revenue immediately from it so that you can feed it right into ads. Or people just aren't looking for what you're offering. They're not like Googling for a slanket or I don't know, whatever else, DTC products, like a mattress in a box. Those aren't things people are looking for, so you have to go find them. And that usually means performance marketing is the way to go. Virality is a natural fit if your product is just innately better with friends. Everyone is always asking me, how do I add virality to my product? Because it's definitely the best way to grow. It's free, it spreads quickly, grows fast, but it's often not something you could just kind of lop onto a product. It works if your product is naturally better with friends or colleagues, and if it's innately fun to share. Like Airbnb is a good example. There's no like natural virality to it, except people just love talking about their experience. So that works for word of mouth. Sales is similar to performance marketing, actually. It's kind of the same heuristic, except you make more money from each sale, or you just need to train people to use it. And then content is a natural fit if there's just content being generated automatically from your product, or you have a lot of unique data, which you can use to generate millions of pages for Google to crawl. Like Thumbtack is really good at this, actually, where they have, I don't know, thousands of pages around best plumber in Topeka, things like that. So those are the heuristics. And okay, so those are the engines we talked about. Let's talk about the three other elements. The second element is what I call turbo boosts, which are one-off boosts in growth, like PR, events, brand marketing. M&A is a good example of this, where they're not going to sustain themselves, but they give you a boost, and it's like pressing a turbo boost in your car. So they're useful. They're useful, especially early on, but they're not going to continue driving growth. So a mistake a lot of founders make is they rely on these things again and again and again, thinking it's going to drive their growth ongoing without investing in their engine. And there's actually a question that Brett asked. He asked if content only works as a growth engine if it's user generated, and it can work in other ways too. I actually have a post that if you Google content-driven growth, and then Lenny, I think Google will find it, where there's actually other ways to use content to drive growth, specifically these data-generated pages that I talked about, where, say, like Yelp does this too, where they have like a bazillion pages of best sushi restaurants in Mill Valley, and they have thousands of those based on data that they've gathered around restaurants. And then another content growth engine is what I call editorially generated content, where employees generate a bunch of great blog posts that become really good for SEO. So yeah, there's other ways, but the best way of doing it is user generated, because it just feeds itself and grows on its own. Okay, so coming back to this, so turbo boosts is an important element of growth, but just don't confuse it with an engine. Then there's lubricants, which are investments that make everything just run better, that make your engine run more efficiently. So if you increase conversion, if you increase activation rate, if you increase retention, everything just runs better. But you're not going to make or break your business by continuing to invest in conversion, for example. Retention is a very special one, which we talked about. But once you're at a place where you feel like you have product market fit, retention is just going to make everything run better. It's not going to bring new users in. And then the last element is fuel. This is just what feeds the engine. You're not going to impact this too much, but basically your options are, is it money, like performance marketing and sales driven by capital? Is it content, or is it users? So this is the framework that I find really useful to use when thinking about just how do I structure my growth strategy? Which of these engines is most likely going to generate growth? And then how do we invest in a few turbo boosts here and there? When do we invest in lubricants? And then what's the fuel that's driving everything? Okay, so that's how your company is going to grow long-term. How do you start growth initially? How do you get your early users? And so I'm going to share a little bit about just how companies got their first 1,000 users. And there's something I'm still developing, and I'd love feedback on this because it's a new thought I haven't shared much yet, and I haven't written a lot about this yet. So what I find is there's essentially 3 steps to getting your first, say, 1,000 users. First, you want to determine who are your customers who care. Who should you be targeting? Who are kind of your early adopters and your wedge users who are going to care most about what you're building? Then you want to develop a remarkable value prop, and remarkable just means something people remark about and get really excited about. And then you figure out, okay, where are these customers who care so that I can go pitch them this value prop? So these are the 3 steps. So step 1, figure out who your customers who care are. And here are some examples of companies that have done well and who their initial customers were. TikTok focused on these bottom tier influencers. Netflix focused on DVD fanatics online and forums. Tinder focused on attractive party-loving college students in LA. Uber focused on tech employees in San Francisco. So this was kind of their narrow wedge of users to start. And the question you want to ask yourself is, who's feeling the most pain from this not existing? Who would benefit most, and not just most, but who would significantly benefit from this existing, and who would pay for the thing that you're offering? These are just questions to ask yourself to help you land on who are these customers that care most about what you're building. Okay, so you have a sense of roughly of who you should be targeting. Then the question is, how do you develop a value prop that's going to really be interesting to them? Some examples: Robinhood's value prop that kind of led to an immediate surge of users is that it was 0% stock trading commissions. Dropbox's initial value prop that led to their sitting in the back of the car being pulled forward moment was this pitch of throw away your USB drive. Netflix eventually got to this place where their value prop was rent as many movies as you want, no late fees. A few more examples: DoorDash eventually realized their value prop to restaurants was make more money, no risk at all, no downside whatsoever. Tinder's value prop was see you single on campus and if they like you. And so the key is just think about what's going to be most remarkable and compelling to your customers who care. And let me just say, a lot of companies don't realize this immediately. They don't often get it right immediately. It's totally cool. You're going to learn and iterate, but it's important to think about these two things at least. And in terms of the value prop, just some questions to ask yourself to come up with what your value prop is going to be. What are the alternatives to this problem, like USB drive versus this file in the cloud? What are unique attributes of what we're doing? Like Netflix is no cancellation, no late fees. So focus on those. And then just what is the value this product enables for the user? Not just what is the value of the product, but what superpower does it unlock for the user? And then the final piece is, now that you know who are your customers who care and what are you going to pitch them, now you got to figure out where to go and where to pitch them. And the question you want to ask yourself is, where are these people spending time? And it turns out there's basically 10 ways to find your early customers. And this is based on basically every company I've ever looked at. They find their initial 1,000 customers in one of these 10 places, in one of these 10 ways. And I'll just read them quickly, and then I'll give you a few examples. So almost every company starts off just reaching out to their friends and colleagues, especially B2B businesses start off just direct outreach to friends and colleagues and family. Then you reach out to targeted strangers. And this isn't like you do them all. Usually it's one or two that actually work really well. But these are the options you have. This kind of like your cheat sheet. Which of these do we think we're going to get the most value out of? A lot of companies, I don't know if the word infiltrate is the best word, but it's the one I've come up with for now. They infiltrate offline communities or they infiltrate online communities and pitch their product there. Or you could build your own community. A lot of companies grow through influencers or PR or partnerships, physical placement, or a really interesting one around supply driving demand, which I'll talk about briefly. And so let me give you a few examples of these. And something that came out of this as I was thinking about this is, if you look at this list, it's actually kind of this series of concentric circles that emanate from the founder, that the further down that list you go, the more work and friction it is to get to that audience. So you want as much as you can to build your early users. And I'll go back one early in this list if you can, because the later you go, the more expensive and difficult and unreliable that tactic is. So that's kind of interesting, I thought. Wow, those animations. So the first example is reaching out to friends and colleagues. So basically every company I talked to started here. Some had a ton of success scaling really quickly, mostly through friends and colleagues, like Yelp, and LinkedIn actually was mostly initially just friends of the founders. Substack started with this one writer, Bill Bishop, who was a colleague of one of the founders of Substack and signed up. And they kind of built Substack around this guy. Salesforce started with Mark Benioff's former colleague and became their first customer. I forget his name, but something I find with B2B businesses especially is the reason friends and former colleagues, because it becomes a really common early growth lever, is because you need to have a lot of trust in the product and the founder to kind of make the bet that it's worth the time of the company adopting this thing. And so this is a really effective lever for B2B businesses, is leaning on former friends and colleagues. So you start there. Then the next layer is reaching out to very targeted strangers who might be a good fit, these kind of customers who care. So what Cameo did to start is they hired interns for $10 an hour, and they just DM'd these kind of C-list celebrities to convince them to try Cameo. DoorDash went door to door, and they picked restaurants that they thought would be a good fit for the platform. TikTok just DM'd and emailed specific influencers. Udemy found like experts in Ruby and writing and just reached out to them and pitched them on Udemy. A really interesting one is going offline and kind of finding offline communities or infiltrating them. Etsy is famous for heading to craft fairs, where obviously who are the customers who care about Etsy? On the supply side especially, it's people making crafty things. And so there's these craft fairs that happen around the country. So they went there and pitched sellers directly. Lyft, if you live, I don't know, imagine this happened everywhere, but if you had a big startup, you're just constantly seeing coupons coming to the office, and I don't know, balloons and cupcakes. In San Francisco, they were just always walking around with balloons and cupcakes, giving them out to startup founders and teams. Tinder is famous for having parties in, I think it was USC in LA, and giving everyone access if they install Tinder. And Pinterest has a really funny story where Ben went to the Apple stores that around his town and loaded up Pinterest.com and all of the laptops in the store, and stood in the back and was just like watching people check out Pinterest. And I think he just like, oh, Pinterest, what's that? And I don't know how much impact that had, but it's a good hack and fun story. Another lever / strategy is just to create your own community and your own platform before you're starting out. So Product Hunt started as an email list that Ryan Hoover had and built that into a site and a business. TikTok built a community of influencers when they started. Stack Overflow had a podcast and a blog that the founders had, and they built this company based on that audience. Patreon built their early users around the musician community that Jack Conti had, his friends basically. Then another example, PR. So PR works for a lot of companies. There's a lot of dissing of PR, but it actually is really effective for a lot of businesses. Instacart was their primary growth lever for a lot of their early years. And what they did is every time they launched into a new city or they added a big new feature, they had a PR event and a story, and that helped drive a lot of their early users. Udemy got their first 1,000 users from just a big story. Spotify, again, every country they launched in, they had a press release. Airbnb actually grew mostly through PR initially. They had this whole Obama O's and Captain McCain's cereal story that got a lot of attention when they were struggling. And it was a lot of PR success there. Physical placement is also really interesting. DoorDash is a great example where Tony, I think, he went around the Stanford campus and just plastered flyers all over campus and told people you can get delivery from this hummus place that everyone loved. And then they stuffed flyers into the delivery bags, similar to Instacart. They put their logo on the delivery bags, and that became a thing people started seeing around. Okay, so those are just a few examples. There's also this kind of meta strategy of just creating FOMO, fear of missing out about your product, where you either create a wait list or some kind of exclusive access to what you're building. And what I find for FOMO to work in your product is you need two things. You need really cool people on the inside, like in the club, dancing and sharing how awesome it is. And then you need that velvet rope keeping people out, which is the wait list. It doesn't work usually just having one or the other. Otherwise, people get frustrated or don't care. So this is just like a meta thing you can layer on top a lot of these strategies. And these are the examples of companies that did that. So just to summarize, just a few takeaways that came to me as I was putting this last element together is if you're building a consumer business, most startups found their early users from a single strategy of these 10 that I shared. Usually just one brings you the first 10,000 plus early users. That most of the strategies involve going to your users directly, not just running a PR event or having an influencer talk about it. Sometimes that works, but usually involves actively seeking out people. And then before you execute on this, it's important to think about, again, who are your customers who care? What are you going to pitch them? It's going to get them excited to even care about what you're offering. And then on the B2B side, there's only 4 strategies that are most successful for B2B businesses, which are friends and family, reaching out to them, reaching out to targeted strangers, infiltrating online communities or sometimes offline communities, and then PR. Those are the ones that seem to work most for B2B companies. And for that reason, it's actually a huge advantage if you come into building an enterprise business with a big network. And this is part of the reason that YC is really valuable, is you just bootstrap a huge network of awesome founders and companies. So that's kind of interesting, I thought. And I think I talked about how just tapping into your network is important for B2B because people need to trust. You don't have to sell them on it as much. They kind of trust, oh yeah, Mark Benioff, he's great. He's not going to screw me here, so I'm going to try it out. So that's really important. And just to summarize, so the things that we explored, 6 ways to know if you have product market fit, 3 really kind of direct big ways, and then 3 early signals. We talked about what is good and great retention. And I shared these kind of 2 frameworks for long-term growth and initial growth of thinking about your growth strategy and executing on your growth strategy. And hopefully that'll help you raise a ton of money and live happily ever after with your company. And with that, I think we're going to move to Q&A.
Thank you so much. And every time I see this stuff, I'm like, if you aren't reading this kind of information and you ask for funding, it seems like the VC should, ask you to go do some homework. Like it astonishes me to this day, the number of people that don't take the time. And I remember when we were working years and years ago at Year One Labs, we would ask you and other startups, how are you doing? And the answer would kind of be pretty good. How's churn? 12. Is that a good number? I don't know. And it seems like in the last decade, people have become much more forthcoming about metrics and what's a normal metric. What do you think that's due to?
I think it's less actually forthcoming. I think people have always, especially in like tech, are always willing to share everything they've learned. I think it's just everyone has I don't think anyone's taken the time or has the time to really explore the kind of this triangulation, because everyone's got their own perspective that they kind of have in the back of their mind and they share it. But I don't think anyone's like, okay, well, I guess I don't know how much I can actually trust this thing. Maybe I should ask other people and see where they all kind of settle in. So I think it's just people don't have time to do these things. And the benefit of having kind of making a living writing a newsletter is I have this excuse to go to people and do research and talk to people that I wouldn't have had time if I have a day job.
I'm kind of allergic to the term growth hacking. I think that it's full of dark patterns in many ways where you're tricking someone. And so you've boosted a number like subscribers, but you haven't actually done the hard work to get retention or metrics like that. What are your thoughts on there was a really sketchy growth hack that went around a few years ago where you create a picture of an attractive person on LinkedIn, you friend everyone in that industry, then you download your emails from LinkedIn and you spam the heck out of them. Obviously not a good pattern, violates a whole bunch of anti-spam laws. What are your thoughts on the litmus test for what is good hacking and what is evil hacking?
So maybe from the perspective of an investor, so there's something to be said to the creativity that founders have around growth, especially if it's a turbo boost that one-off gets them something interesting. And but I'd say as an investor, the thing you look for as much as you can is there organic growth happening? Is there just market pull for this thing? And growth hacks don't have that because you're just doing something actively. So the less hacks you need, the better it often is as an investor. But at the same time, I think it's really there's a lot of, Twitter is a really interesting lever these days where people can use it to spike growth and have a little boost. And I think it's a really promising, good thing in general. But yeah, I don't know what the exact line is. This is not cool.
It's weird. You sort of know it when you see it, right?
Yeah, exactly.
So all these lessons are great, but in many cases, the things that companies did to find that growth and build that brand required a certain amount of oxygen, like there's a certain amount of traffic. Google and Facebook can do split testing every minute because they have so much traffic. How do you get learnings when you don't have enough traffic? Because this is a perennial problem for really early stages, the chicken and egg of, I don't have users to get traffic. I don't have traffic to figure out what the users want.
Yeah, it is a really big problem, and a lot of companies solve this by just running paid ads, which is an easy solution. The problem with paid ads is the intent of users is so much lower, and so it's not going to be a really good sample. But because they're low intent, if you can get them over the hump and excited, it's an even better sign that you're building something people really want. So paid ads are an interesting way of doing it. The other is usually you're not going to be able to run A/B tests for a long time as a startup. It's very people often try to run experiments and think they're building something based on data, and in reality they don't know. Like, it's all complete nonsense experiments because there's just not enough data. And so what I find is you don't go at it from that direction. You often just approach it qualitatively and basically just talk to people, because you're not going to get anywhere close to having experiments that are valid anyway. So forget that.
How does a founder manage that sort of the zen of, on the one hand, I have complete faith that I've invented the best thing in the world and no one's going to shake that, like I'm driven. On the other hand, I have incredible humility and I'm aware that everything I'm doing is probably wrong. And like, the cognitive dissonance alone should send everyone to therapy. What's your best rule for the founder to be able to find that balance?
That's a good question. And it's something I've been hearing more and more from founders, is just like, man, this has taken a long time. I don't know if we should be continuing down this direction. Like, yeah, this is something that comes up all the time. I don't have a great answer for that, because sometimes it ends up not working out. And how long do you want to spend bashing your head against the wall before giving up? But it often does work out. And as an example, Airbnb, it took them, if you look at the chart of growth, it took like 2 years of just nothing happening. And then all of a sudden it starts to work. So it is tough. I think it's like maybe a heuristic I like is just like give it like 100% more space to like double what your natural inclination is of, okay, this isn't going to work, and give it that like extra bonus time of like twice what you would have if you maybe weren't the founder, and just keep it going for that much longer. And then maybe start thinking about a pivot, because a lot of times pivoting sooner than later is the better thing to do before you run out of money. Yeah,
I remember with Cohort, it took us like 5 or 6 years to figure out how to say to people, like, we did web performance management, that stuff, but we would say to people, oh, analytics tells you what people did, we show you if they could do it, which sounds like the simplest sentence in the world. But once we knew how to say that, we closed all these big customers, because they're like, well, of course I need that. But it literally took me 5 years to figure out how to say that in a sentence. And like, looking back on that, it's 5 years and probably $20 million wasted in the managed services business, and just $20 million in $2001 to not figure out how to say something simply. It really feels like, getting there sooner really matters, right?
Yeah, I recently had a guest post by April Dunford about positioning, and that is just reminding me how important it is to figure out how to position your product and use the right words. And like, Amplitude comes to mind as a good example, where they initially thought they were building a tool for marketers to help them test marketing copy and things like that. And as soon as they started testing a product for product managers and product teams, where the story that one of the early growth people shared is, as soon as they started pitching it that way, they were at a conference and he was just standing there, and he heard this product manager just kind of saying, like, this is the first time in my career that a product is finally built for what I need, and it's my favorite product because of that. And it's all a good
line for product market fit.
Yeah, exactly. That's exactly when they felt like, okay, we finally got something. People are talking about it, and that's like the pupils dilate moment, exactly. And it was basically positioning change. The product itself didn't significantly change at that point.
So a couple of quick questions. Louis wants to know, he's asking about growth hacking, but obviously this idea that, growth hacking is finding all of the different things, trying them out and seeing which one works best. What do you think is too few numbers to be doing like split testing or, multi-arm bandit or A/B tests?
So there's a really handy calculator that I come to every time. If you Google Optimizely experiment sample calculator or something like that, Optimizely has a really great calculator where you just enter how many visitors you're expecting to get and what percentage impact you're expecting from it. And tells you basically how many visits you need and how many samples you need for it to be of any validity. So use technology to solve this problem.
A few people have asked this, and there was a pretty scathing, but I think also important to confront article by Alex Danko about startup ecosystems and San Francisco. And he says that, most of the problem is angels, that you need success stories that generate angels who put money in with the intent of playing an infinite game, meaning they want to play to keep playing, as opposed to I want to get 3 times or 10 times out. And so where you are like looking at the startup ecosystems in the world, I know you've become very active in the Airbnb alumni kind of investment ecosystem. Can you tell me, as you interact with product managers around the world and with startup founders around the world, do certain communities develop better product managers? And what are the things in the ecosystem that are needed to develop that? And how much of that is angels versus, SRED credits, which we have in Canada, tax credits, more mechanical sort of support for the community?
So is your question around product managers or angel?
Yes.
Okay, I'll try to answer both. I think on the first piece, something I've found more and more, I've been lucky to work at modern tech companies like an Airbnb, where it's a product-led company where the founders understand that we're going to win because of technology and not other things. And in those cases, product teams are empowered to lead and set vision, set strategy, and have power over what's being built, versus a lot of companies have unempowered. They're more like feature teams, where they're just told what to build. Especially as a PM, that's you become basically a project manager versus a product manager. So what I would say is the companies that you want to work at and that end up, I think, doing better, especially these days, are companies where the product teams are empowered versus are just told what to build. So that's something I've looked for. And the way to think about that and the way to see it is just like, do you have say? How much say do you have over the vision, over the strategy, over priorities as a product team? And is your team cross-functional? Is it kind of like a unit of cross-functional resources that are all building towards an outcome, versus there's PMs over here, engineers there, designers there, and you're all kind of just told what to build by someone from above? So that's
does P&L responsibility enter into that as well?
Not often in my experience. I think that's more like the GM role, if you're much more senior. Usually not. Yeah. And then in terms of angels, one thing that so Alex Tinko talked about this idea of angels investing without like looking to make money from it. And I haven't found those angels yet, to be honest. Usually people are investing to make a return. Maybe I'm just not in the right circles yet, but yeah, that was kind of surprising to hear.
Yeah, that does sound more like patronage, although I did like his idea of like the kind of angels shape the kind of investors that get backing. So what do you think it is? I mean, if it isn't that Valley Angels don't want to make money, what do you think it is that makes San Francisco, and we're going to be talking to Sofia Quintero in a minute, and I literally have an email from her, which I'm going to show as I awkwardly introduce her, where she's like, I'm moving to San Francisco because I can't wait this long. Literally that email, and now she's got a thriving business. So what is the sense you have of what's different about the startup ecosystem or the angels that everyone sort of points to that Silicon Valley magic? If it's not, people don't actually want to make money, which I think you're right. That's kind of a long story.
Yeah. I'm no expert on what makes Silicon Valley what it is, but I guess in my experience, I think it's just simply there's just a lot more companies, founders, investors here. And so you just meet more people, you run into people more often. It's much easier to meet people. And, just through numbers game, you're going to end up being more successful. And then I think there's just like more people with money here because of all of that. And so there's a lot more liquidity and optionality. And I think those two alone.
I did like his point about asymmetry, that when there are so many startups asking for money, you don't have time to find all the reasons why you shouldn't invest because you've got FOMO. So I guess one interesting rat hole to go down is, as people build more and more machine learning enabled VC firms that sort of look at the financials and use whatever stats and prediction, you lose the supply side asymmetry that gives founders an advantage and makes deals happen fast. Maybe machines are going to say no a lot more. That's a problem for what makes the ecosystem work, right?
But then I wonder how much that model will factor in their location and their access to other investors and angels. Yeah,
absolutely. Interesting question. Okay, we have one last question. How realistic is it to pitch a prototype instead of an MVP for B2B at a pre-financing stage?
Super realistic. I think what's cool about B2B is the customers are a lot clearer in what they want and what problems they have versus like, yeah, I'd use that photo app. So prototypes are awesome. And that's where you look for this like pupil dilation feeling of just like, holy shit, I will buy this thing. And what's cool about businesses, you can even have them pay now for first access to this thing. So prototypes are great. You know, like a lot of companies raise money with just Figma files or just decks even today. And so I would not be worried about pitching a prototype when you're raising money or even to customers.
Speaking of Figma, do you think the Figma no-code kind of trends are going to bring a new generation of entrepreneurs into tech that don't understand it necessarily?
Absolutely. Absolutely. It's so much easier to try stuff, and you can get so far with like a Webflow or a Coda or all these prototyping tools. Absolutely. It's initially I was very skeptical being an engineer trying to think how you could automate a no-code code, but it's like actually working and people love it. It's such a cult and it's working really well. So I think it's only going to expand the software eating of the world, and I'm excited about it.
Yeah, it's definitely a good appetizer. I played around Bubble a bit, and it's amazing how much you can build in there. Okay, so Lenny, what's the next big topic you're tackling on your newsletter?
So I'm actually going to turn this talk into a series of 5 or 6 posts where I dive into getting your first 10,000 users. So that's coming. And then my next post coming next week, I'm excited about it. It's going to be a guest post about taking sabbaticals and how to take a sabbatical well.
Are you going to take a sabbatical while someone else writes that?
Here's the thing. I can't take any time off in this life because people are paying me for a newsletter every week. So that's a challenge of this lifestyle. So no sabbatical plans currently.
You should bank this one. You should write one next week, and then you can use the sabbatical one.
I try. That is, it turns out that it's very hard. I wish I had like a year of posts ready to go, but I'm always just in time every week.
Well, I think that's one of the things that makes the newsletter so topical too, is like most of your posts have come straight out of some headline I'm seeing somewhere in the startup world. So you're definitely doing the world a huge service with this. What do you miss most about being at Airbnb?
People and amazing free food.
Well, you know, you can get free food if you're earning decent money from the newsletter. I think people, that may be more than just Airbnb, right?
Airbnb people. Yeah. Those people are a special bunch.
Excellent. Well, Lenny, as usual, thank you so much. It's great to see your face again. And it's been very sad to not visit San Francisco for the last little while. Really appreciate you. You're certainly like a prodigal son of Montreal. We miss you here too. Although you should come back when it's warmer this time. Thank you so much for spending some time with us today. And I'm going to point people at your newsletter after this, but there's so much good content in there. So much less of startups is guesswork thanks to the kind of writing and publishing and research that you're doing. And I think it is probably reducing the amount of waste in the startup ecosystem worldwide more than you can imagine, which is an incredible thing because like the whole idea about lean is to reduce waste. So you're probably really moving the needle significantly. And on behalf of all the people in chat who are saying nice things about you, thank you so much for being here. We really appreciate it.
You bet, Alistair. Thanks for having me. Let's reduce some waste. Thank you, everyone.